dynamic seems to have contributed to the fragmentation in the market. And I guess we have seen that you can't be an exchange worth your salt today if you don't have at least two markets, right? And a lot of the market differentiation is based upon pricing. So maybe, Todd, I'd throw this to you. If we didn't have rebates in active names, right, or those fee caps came down significantly, do you think we'd have as many exchanges as we do today?
No. I mean, when you think about it, a lot of, just take the perspective of posting passive limit orders. It's interesting, especially in some of the thick Q stocks. If you want to maximize fill rate, the best place to represent your order is the one that's the least expensive to remove from. I mean, it's just without question, it's always that way, And if you don't believe me, post an order on Boston, post one on ARCA, and see which one gets taken first. And, I think that creates a lot of conflicts for brokers in terms of how are we making sure that we're satisfying best X requirements for our clients, and it just creates a lot of complexity. I think if you remove the access fee or rebate component from the equation, those decisions get a lot easier to make, and we end up in a lot less places, and I think volume starts to get concentrated.
Great. So another issue is price discovery, right? So price discovery, anytime that we talk about the issue of internalization or these related things, a price discovery issue is usually one that seems to be identified. And I guess the real question is do we really have a price discovery problem? And I know we've seen some data that's been out there, some of which was, I think, disputed in the Canada panel this morning. But is there a price discovery panel? And also maybe what is Nichols, does that change price discovery? Does that make it more efficient, less efficient?
I believe that there's a lot of academic work in this area. I mean, you get two types of approaches to markets. One is information mining, which is all the computer-based trading. And then you've got information additive strategies, which is fundamental. The more efficient markets become in the sense of lower price, lower cost, the more it incents people to trade baskets, exchange-traded funds, derivatives, and that starts to interfere. I'm not talking about different kind of price discovery. That causes stocks to trade in baskets. It increases correlations across industry groups, even ultimately across asset classes. And so if you look at it from the standpoint of markets being able to properly price securities, there's a school of thought that says that the more efficient these markets become or the lower cost to transact in, the more we push the dial in the direction of information mining, which takes away the ability of markets to inject fundamental information and price securities based on fundamentals.
There's a great French study about price points of looking at the natural price points where things trade. And we'd actually, before we put in increments, we had Professor Christie in Nashville, who everybody remembers, study kind of the natural trading increments of securities. And he saw that they clustered around various areas, and we tried to design the increments around those clusters. But part of markets is organizing them in a way so the activity does start to cluster, and whether it's quotes, orders, and as we watch the data come adjust, because quotes and orders we don't think are that dysfunctional, of clustering forcing trades is another question that could have wider ramifications to the market. So we want to bring in, for small companies, I think especially, we want probably a fewer price points. There's a lot of price points if something's trading 1,000 times a second. You probably should have. But the average stock in the OTC market trades 30 times a day. So that's once every 1,000 seconds. And that's going to need, more price point, wider price points. It's also going to need more intermediaries because there's not going to be the natural other side all the time.
So just back to the point earlier about what do we call them, broker discount centers?
Yeah,
right?
The dark pools or broker discount systems.
On the broker discount centers, then if we want liquidity to aggregate at a price point, would the exchange community be concerned that that's going to be potentially undermined by a lot of internalization happening inside of those price points?
But that means the market's priced properly. It's like you don't need the person setting the price. If the price is at the right level of buying and selling, those people making the offers don't need to be the ones there all the time. One of the exchange view of, they say we're only getting toxic order flow. And toxic order flow means price impact order flow. It's moving the market. And it's actually worth a lot more. That's why the primary exchange has a lot more value in their market data, because they're seen as the price setter. And people are interacting with that because the market needs to move. And so if a market at a perfect level, I mean, when I came into the business, this market maker described it's like there's a pipe that water goes through and we just kind of move it up and down to find a balance. That's the bid offer. And it all kind of works as long as you're moving it at the right level. And that's, you know, the NBBO and securities is that level. We don't want a central limit order book. I don't think we want that because, you know, the trains do run on time in Italy back in the 30s, and everybody stood in line. But it was not like this competition that's a little messier. There's this scary thing of fragmentation, which just means distributed trading. It all trades at or within the NBBO for the most part. It's pretty awesome, you know, and that is, fragmentation is a sign of competition and choice. There's a lot of diverse broker-sponsored execution venues. There's a lot of hugely competitive stock exchanges we have, and they all work generally pretty well. I mean, I don't really think that saying, oh, let's move it all to one place where we can all watch it. It can be really nicely organized, and then we can kill innovation.
We're gearing up for questions, so if anybody has any questions, I'm going to keep asking, but throw your hands up. Steve, you got one there? And then for you, Steve, you're next.
Thanks. David, you were the first to convince me, you said it again today, that it wasn't decimals that killed the IPOs, it was the market structure that killed the IPOs. We're talking here about, is this a Trojan horse or trade at, or do we need to fiddle with taker fees or whatever? We should remember that the reason taker fees came around is that we have, where we're handling rules in the NASDAQ market, and then later we have the Reg MS listed market, which were intended to and did force those markets to become immediate electronic marketplaces.
Right.
And also greater whole fragmentation.
Right.
Now, it seems to me we're all about going into some kind of a pilot to see if we can revive capital formation. You might want to revive as a pilot the whole picture. If companies are going to be able to pick their tick, maybe they ought to be able to pick a NASDAQ-like dealer market as well that operated on the telephone.
Yeah.
As opposed to an electronic market, which
Yeah.
I think the study very clearly showed is the reason that the
Yeah, Steve, we wrote an op-ed that was published in the Wall Street Journal that basically advocated for, a new market that was focused on the needs of small cap companies. Because one of the things that's happened now that we have 40 trading venues is there's only two, markets basically left to include, 3 if you include the over-the-counter market and Cromwell that have any interest in advocating for the interests of issuers, whereas everybody else is focused on trading. That's all they do. So we're an enormous economy. We can afford to experiment with market structures, okay? I don't understand why we don't, okay? But if you look at it from a systemic risk standpoint, we have put all of our eggs in this one basket, and this basket, at least from the standpoint of creating new companies for the listed markets, is breaking all the eggs right now. We're down nearly 50% from the peak in terms of the numbers of listed companies. I mean, that's how big the decline has been. What? More than 50? From Jim Angel. So, I mean, it's scary, and that's why I say if you want to kind of work on something, put on your red, white, and blue epaulets, your patriotic duty, take that sheet, figure it out yourself, from your own firms, write your own letters to Congress, but now is the time to strike. And when we talk about trade at rule, I'm not looking at that as a Trojan horse. For me, when I say trade at in small cap, micro cap stocks, I'm really sincerely about getting the economics into the hands of the value providers. You can compete on symmetrical order book markets, the large cap markets, where there's big buyers to offset sellers on the basis of price. And I think it works reasonably well. But when you get to the micro cap markets where they're asymmetrical in academic terms, big buyer, no seller, big seller, no buyer, you need liquidity providers to be incented to step in the middle, to create liquidity, to disseminate information, to do all those things that traders, when we used to say we're getting long and loud, okay, they need to get paid to do that. Those markets trade differently. So trade at rule to get economics into the value providers in micro cap, small cap stocks, I'm all for that. I'm not sure that, you know, I want to get into that dog fight in large cap stocks. I'm not sure it's even necessary.
So Tom, if we go to a nickel pilot, maybe even a dime pilot in certain names, or you guys think you would pick up coverage of a lot of these names?
We would, and one of the caveats is, you know, what's the time frame for that study to determine that? And one thing we got to be aware of, you know, just that ramp up. Once you see that there's, you know, viability there, an economic viability, and you can actually build this research and corporate access infrastructure around those type of companies, it's got to be 2 years. I don't think in a one-year period. I mean, you hire a research analyst today, you know, it takes 6 months before they're up and publishing anyway. And then you have to get them out and on the road for another 3 months. So it's not for a year until people have that story out there kind of widely disseminated. So yeah, I think the time part of it is going to be very important to get that whole infrastructure around it.
Okay, we got a question from Brian.
Hey, when we think about the tick sizes, if you rewind the clock and you go back to decimalization, obviously traders are going to want a wider spread so they can commit capital. We understand that concept. But why is it that a firm like Cowen or regional bank, Riley, why are you guys focused on the space, but not Goldman, Morgan Stanley? If you know, if you want to be in the business of research, investment banking, taking these companies public, yeah, I mean, is it all about the trading? Why aren't the big fish chasing it? Are they just ceding that neighborhood to you? That's not clear to me.
Should we ask the big fish? Are you going to be doing this?
It's not necessarily my area of expertise, given I'm on the trading side, but I think it's a matter of, you know, like, you rationalize your
Scale.
Yeah, how you allocate resources in an environment like we're in. We make decisions about, you know, where we can get the greatest return on equity. And I think given some of the metrics that were referred to earlier and some of the statistics about volume and opportunity, it's just not the right decision for our shareholders, quite frankly.
Well, Goldman's got to
Yeah.
do big deals to move the needle. I mean, you know, and you know, smaller firms, smaller overhead, fewer people. You know, they can specialize in a niche that's not covered by the bulge, where the brands are stronger, and they can actually earn a return. The problem is that as that one-size-fits-all economic model of penny tick sizes come down everywhere, it's gotten it to the point where guys that are banking small cap, nano cap, micro cap stocks are actually losing money by providing aftermarket support services.
That's correct.
I guess I'm sorry.
So I worked at 2 bulge firms over 20 years, and they were both small when